Hello and welcome to this edition of IPO Adda. Lemon Tree Hotels has opened its IPO for subscription today. Joining us to talk about this company, we have the management and chairman and MD of the company. Thank you so much, sir, for joining in. Talking about Lemon Tree, if you could tell us more about your business model, and in the recent times we have seen the hotel stocks doing well. So in terms of your average revenue per room, in terms of your occupancy rates, if you could tell us more about your business.
Lemon Tree is, if you've read our RHP, according to Harvard HTL, we are the largest mid-market hotel chain in India. We operate across the 2, 3 and 4-star price points, which are called economy or budget, mid-scale and upper mid-scale. We currently have 4,700 rooms as of 31st of January. The total supply of mid-market hotel rooms, well, we have an older figure, which is 31st March last year, was 53,000 rooms. So we have a little under 10% of the mid-market supply. We currently operate in 28 cities across all these 3 brands, and in the next 3 years, we are expanding, adding another 3,000 rooms, so we will be 7,700 rooms, at which point in time we expect that if all the hotels under development in the mid-market space in India are ready, then there will be roughly 78,000 rooms in India in the mid-market space. So we will be about 10% of that. You have to keep in mind it's a very fragmented space because there are multiple standalone hotels, different owners and so on. So it's a fairly, respectable number to have close to 10% of those rooms. Now, if you look at the hotel industry, there are 3 levels. There is top of cycle, middle of cycle, bottom of cycle, which means at these different price points, you earn, your pricing power changes dramatically. India has gone through bottom of cycle conditions for the last 10 years because there has been a huge amount of supply that was injected into the space. But going forward next 4 years, according to the same report I talked about, there will be a shortage of rooms because supply is slowing down dramatically and demand is continuing at over 12% a year. So we expect the next 4 years will be moving towards top of cycle in the Indian hotel industry, which means that there will be a return of pricing power in this sector. To come to your question about revenue per room, we've had, and I think our average revenue per room is about 3,000 bucks a room, averaged out. But going forward, obviously, we hope that it will improve significantly.
Okay. So talking about the outlook for the business, and more importantly, if you could tell us how really the company positioning itself in terms of sub-segments like corporate and leisure destination hotels, and which segment do you think would fare better in the next 2 to 3 years? Would the focus be more on the tier 1 cities and business hotels front?
Sorry, I'd like to actually, I needed to add one more point to your previous question, which was pricing power. So if you look at our RHP in the 9 months of this year, we managed to achieve a price hike of about 9%, which really did not happen across the entire year, though this is an average number across 9 months. We increased our prices in September and October. So obviously our price hike was significantly higher than this 9%, which is the average of 9 months. And going forward, we expect that this ability to reprice will continue for the next 4 years. Now, coming back to your other question, which is on leisure and business destinations. Well, what I find is in the last 5 years, demand for mid-market hotels has grown at about 18% a year. This has primarily been led by domestic young Indians, domestic consumers under the age of 40 with who have hired, increasing disposable income and who have wanted to move from the unbranded sector into the branded mid-market sector, providing it offers value for money. And now this applies both for business and leisure hotels. Leisure was typically a highly cyclical business in the past, but what I find very encouraging is in the last 5 to 6 years, the cyclicality or the seasonality of this business is reduced vastly because Indians are traveling around the year for leisure purposes, and it's, at least in our case, it has been very visible in our leisure hotels. So going forward, I would bet equally on both the business hotels and the leisure hotels, whereas in the past we were more business focused.
Okay. Sir, I was looking at your business and how it has evolved. Earlier, you used to own and operate hotels, and now you're looking, at leasing back and, entering management contracts, which probably makes the business asset light. So if you could throw more light as to how the company would be looking to expand, will it be fully, asset light, or would you still like to look at owning hotel properties?
Okay, so let's go 4 years back and 4 years forward. 4 years back, we were 100%, we owned all our hotels. Then we felt that our brand was strong enough to be monetized, so we created a subsidiary called Carnation Hotels, whose, where we went after management contracts. And in the last 4 years, we've opened a large number of hotels, I think 16 hotels, which we manage on behalf of other owners. And we have signed another 21 such hotels. So totally by FY21, we will have 37 hotels under management out of the 77 that we will operate. So 40 hotels will be owned by us, 37 will be managed by us. If you look at our IPO, we are not raising any primary capital because we are fully funded for this growth going forward. Out of the 3,000 rooms we are opening in the next 3 years, 1,600 rooms will be owned by us and 1,400 will be managed. So finally, when you look at these 7,700 rooms I'm talking about 2,900 will be managed and about 4,800 will be owned by us.
Okay, good to know that, sir. But talking about the balance sheet position of the company, I collect that, you have close to 975 crores of debt. If you could tell us how the trajectory will move forward, because you are undertaking a lot of expansion. So, what will be the optimum debt to equity ratio that you are currently working with moving forward?
We are spending 1,700 crores on these 1,600 rooms that we are developing right now, which we own in the next 3 years. Of the 1,700 crores, 700 crores has already been invested. And of the incremental 1,000 crores, we plan to borrow 400 more crores, and we expect we will have internal accruals of the balance. So our debt at peak, actually, including, because we will be repaying some of this debt in the next 4 years, at peak will not cross 1:1 debt equity, which is our debt will be less than 1,300 crores. Number two is that going forward with the return of pricing power coming to this industry, we expect we will be able to not only service this debt but pay it off in the next few years. And after that, we are looking primarily at growth in a very asset-light way through management contracts. So we do not see the need for further capital in the company.
Sir, when we look at your revenue breakup, what I gathered is that you have a very low share from the food and beverage segment. It currently contributes close to 20% of your top line versus 35 to 40% for your peer set. How do you plan to really take up the contribution from F&B, or probably look at more contribution or more focus on the F&B segment so that your margins move up?
So here's the dichotomy. I want, if possible, more and more room income, because that is where the maximum profit flows from. So let me give you an example. In terms of contribution, for every 100 rupees I earn from room income, on a contribution basis, 90 or 95 flows straight to the bottom line. Whereas in F&B, it is less than 60. So I don't know why this is considered a disadvantage. In fact, I see this as a competitive advantage in Lemon Tree, that a majority of our income is room income. And that's true globally. So what's an advantage for us should be seen as that. And frankly, going forward, I would prefer more room income rather than more F&B income.
Sir, my question really was that if the contribution from F&B moves up, your average revenue per room increases. So probably even if you have a good, 60% margin on F&B, and if you could garner higher sales in the F&B segment, your overall operating profits should improve and the asset should sweat better. So if you could just clarify as to, will the company focus on F&B, or, probably F&B remains a non-core part of the business strategy?
No, but it's not that we do not attempt to get that. I think the difference in income between other hotel chains and us in our segment, which is due to F&B income, is primarily driven by banquet income, and we are not so focused on banquets. Otherwise, a consumer who goes to my hotel or goes to somebody else's hotel would still buy breakfast, lunch, and dinner, whether it is my hotel or somebody else's. So that's not where the difference comes. The difference comes with the focus towards banquets and meetings and incentives. And frankly, that's not a focus area for Lemon Tree. It is not a part of its business model. Lemon Tree is purely focused on sweating its assets, and ultimately that is the return that we get by sale of rooms.
Thank you so much, sir, for speaking to BloombergQuint and taking out the time. All the best for your IPO. So that was the management of Lemon Tree, quite confident that the average rental per room and the kind of industry growth one could see moving forward could be good for hotel industry. However, brokerages still remain cautious on the valuations, as well as remain slightly negative on this particular IPO on the back of the valuation it has. But probably the business strategy is to remain asset light and get a better sweat on the asset. Probably that could improve the margins for the company moving forward.